in action. We're rolling. Welcome. All right. Little show note. Last week we recorded like an hour-long episode. It was really interesting. And then we figured out there was no audio associated with it. So our bad. This is something that we're still trying to figure out the kinks on. And there's only 2 of us here. So, things happen. But we are adding redundancies in this week. So we get the audio if one of them fails.
This is not our day job.
This is not our day job. Well, talking about it, I guess, is our day job. The setup for it is not our day job. But anyway, it's Monday, January 20th, 2025. Today is Inauguration Day. The markets are closed today for Martin Luther King Jr. Day, which is also today.
Yep.
So last week we, again, did not get the episode out, but we talked a little bit about the weakness that we have been seeing in the market. First of all, I'll let you jump into the fine print, the disclosures, and just kind of walk everybody through what this is meant to be, even though, they probably know by now.
Sure. As always, this podcast is intended for informational purposes only. It does not constitute financial advice or recommendation to buy or sell any securities. Always consult with a professional such as ourselves before making investment decisions.
Yep. It's a good one. Anyway, so there was a lot of negativity surrounding the market before last week. Last week we had the Federal Reserve. Well, they didn't really make a decision, but there was inflation information that came out that sort of steadied the market. And we saw actually Wednesday, we saw
Tuesday,
everything
really,
kind of
with
turn around.
PPI coming out, the Producers Price Index, which is more of the wholesale, something we also spoke about, the ISM data.
Yeah, we talked a lot about that. It was a good episode.
Yeah, it was
a shame.
Very good.
We talked about all that stuff. Yeah, it's an unreleased. It'll stay in the vault. It's an unreleased episode.
The PPI came out soft. That obviously you're able to take the information from that and pretty much get an idea of what CPI is going to do. It also came in soft, specifically around core, which is what the Federal Reserve looks at. So really good data to back up the thesis. 2 or 3 rate cuts this year from the Federal Reserve.
Yeah, you still saw some inflation in food and beverage was where the most of it was. And
these things are like $4 now.
Yeah, not great. Let me see where the other one was. I had it pulled up here. I have to pull this up. Inflation was in food and beverages and housing still really kind of high. But you have in sectors like energy where it's actually negative now. And so you kind of saw a little bit of that kind of kick up last week as well. In addition to, on Wednesday, we got maybe some bottoming in the bond market. You saw the TLT, which is the 20-year Treasury,
and when
the iShares.
And when you're saying bottoming of the bond market, that also means the same thing as saying rates have peaked potentially.
Potentially, yeah. So it's a shorter term kind of indicator that we would look at. It's not really an indicator, that's the wrong word, but it's an interesting anecdotal piece of evidence that the bond market may be in for a rally. TLT is seemingly going to get squeezed. There's a lot of short interest, about 14% short interest out on that, which is people betting against it essentially. And you could be potentially going to see a short squeeze, which is going to push that price higher. And maybe the rest of the bond market with it. It's very interesting. But, rally in the bonds is definitely bullish for stocks as well. So that would be what we would hope to see. And we have seen bonds perform well year to date, certainly.
Your large institutional participants in the market look at bond prices and the yields that they bring with them correlated with economic outlook. So if you think the economy is going to grow, you're going to be looking at lower rates in the future. You're going to want to buy as much as you can now and lock in that 5 or 6% corporate yield before the rates come down. So you're going to, yes, correct.
That's right.
A
but
rally in the bond market should be good for with this setup.
So the position that we had been using is for cash, back in 2022 and 2023 a little bit, BIL, which is like a T-bill, basically 1 to 3 month T-bill. It's the yield on that thing is still over 5%.
Same as cash, basically, is what
crazy.
the T-bill is. Yeah, 1 to 3.
Yeah, but I mean, you're. I don't know that anybody's doing 5% cash right now.
No, because what the Fed's at 4 1/4. So.
Yeah. So I mean, the yield is pretty stout, and I've seen some corporate bonds that are over 6. So it's kind of this very weird scenario here where the rates are being cut, but we're not seeing the other effects of that. The other thing would be housing with the mortgage rates.
And we spoke about that last week, and we talked about the ISM Purchasing Managers Index, ISM's PMI index, and its levels and how it correlates with economic outlook, economic activity, and how we were kind of bottoming there. And we go back to 2017 and we look what happened. And I sent you a graphic that kind of is new, is kind of fresh out. The survey was done January 15th to the 17th by CBS News and YouGov about optimism. And so we're seeing an uptick starting to build in the Purchasing Managers Index, which measures, again, last week we covered this in depth, but just real quick, it does measure the confidence of individuals for large companies in buying raw materials in preparation for a pickup in orders. Very important index. It looks like it's bottoming and on the uptrend. And then now it really caught me when I saw this on X, this CBS News poll asking each age group how optimistic they are about the next 4 years with Trump as president. And, CBS News is not a right-leaning, and YouGov they're not right-leaning pollsters by any means. So it's very shocking to see these age brackets, 18 to 29, almost 70% optimism, 30 to 44, 62, 45 to 64, 60, and even over age 65, which increasingly has become a more slightly pessimistic. Yeah, have more of a pessimistic outlook on things in the country. Over 51%. This is, again, laying that foundation for, we have small business optimism has spiked to the highest on record, even going back to after the election 2016, beginning of 2017. It's above that level of optimism. It's above the V recovery, as it was called in 2020, post PPP, post initial stimulus. And then now we're seeing each age bracket in the workforce having a real high level of optimism. And so, yeah, I mean, I think this is creating a mosaic to which you can really look and see a good strong foundation for the market here over the next
strong foundation.
Yeah, over the next 18 to 24 months, I would say.
Do you think the ordering has anything to do with tariff possibility, kind of concerns around tariffs and what they will and won't be able to get at certain prices?
Possibly. It is possible, but you have to. You would only do that to a degree because you're going to have you're going to have a warehousing cost if you don't turn the inventory over. So you're going to pay one way or the other. So if a good that you're trying, let's say if it's furniture, let's say Wayfair, the brands Walmart have that or I wouldn't say IKEA, but a lot of your brands that get you some of your affordable. I helped my mom put one of those things together last week. Anything you can think of that you piece together, it's MDF and it's an affordable thing. You can think of Wayfair. If you're trying to get out ahead of any furniture tariffs, yeah, you could try to order, but those things are bulky and they're heavy. You have to store them somewhere. That has a cost. Is that cost greater than the tariff cost?
Yeah.
Not sure. I would suspect it probably is.
Well, I think that I think that the the other potential, the devil's advocate sort of position there is maybe we get some inventory to last us until we can move our supply chain out of these places that are going to get hit with tariffs.
Correct.
So maybe we have supply. Maybe we eat the cost of storing it for a little while until we can set up shop in Malaysia or,
Vietnam.
Yeah, or
South Korea.
Bangladesh or wherever we're going to build these things from now on to get it out of China.
Maybe Greenland.
Maybe Greenland, yeah. I don't know about that, though.
IKEA makes good stuff.
We talked about Greenland in that video.
Yeah, we did.
That
was a great video. That was excellent.
Yeah,
maybe we'll have to do a redo of it at some point. But on the point of tariffs, and I would caution everyone, and this is why you don't make investment decisions, especially for your retirement, on these types of news headlines. The reason we did not see an increase in inflation, Trump 1.0 with tariffs, and why Biden kept those same tariffs on and never changed them, even though they had the political back and forth about the tariffs. Biden did not take the Chinese tariffs off, is because most of your, when you do either a blanket tariff on the Chinese or if you tariff low value products, anything that's what you would call Econ 101 would teach you is called a perfectly competitive marketplace or a perfectly competitive product. You cannot push prices up vis-a-vis tariffs. All that's going to happen is production manufacturing is just going to move to another location, because when you have a low value good, think about toilet paper, think about regular paper, think about a plastic plant. Those, you cannot price those products at a premium. It's impossible to do with a perfectly competitive market. So you're going to simply, the Vietnamese, the South Koreans, Bangladesh, Malaysia, these places are going to just simply pick up the slack and produce that product. You cannot raise the price on those products as a result of tariffs. Now, there are some things, I'm sure, that
in the longer
that
term
could be affected, but it's very hard, because if you have T-shirts made in Vietnam and you tariff T-shirts made in China, no one's going to pay an extra 30% for the T-shirts in China. They're just going to buy the ones in Vietnam. So the Chinese either have to weaken their currency, drop the price, or just eat the tariff.
Yeah.
Which is the same as them taking less profit, dropping the price. So I would just caution everyone to not, when the news media talks about tariffs, to, there are large corporations, think of Walmart, Costco, Amazon, that, have a seat at the table with lobbying the government. And whatever approach is taken is as we saw under Biden and under Trump, is going to be in the best interest of the American worker. And that's
right.
One thing with disagreements in Biden and Trump are very different. And there's an argument to be made that Biden really wasn't even running the government. But when you look at
certainly what Mike Johnson says,
when you look at both of their approaches to, on average, the American worker vis-a-vis tariffs, you could argue that it was very similar. Biden obviously nowhere near as aggressive or articulate or pointed in the approach that they did. But again,
I think the more interesting
if he wasn't making the decisions, you could almost kind of forgive him. All these polls are
I don't know if I'd go that far.
All these polls are showing such terrible approval, rating, and Jimmy Carter, rest his soul, don't speak ill of the dead. But there's a lot of comparisons there. But I don't know. I think as more information comes out about cognitive issues, it's almost like,
I don't think he gets a pass for that. I think the more interesting thing, though, is, when the tariffs were being put on in the first Trump administration, I remember you and I were at a conference or something with a fund manager or something that I don't know where we were.
We were in.
That was actually before Trump was elected. Actually,
no, we were. We were in Washington, D.C.
Was that Washington, D.C.?
In 2015. And
okay.
it was a fund company called Horizon. They are still around.
Okay, yeah, that's right. So they were essentially giving a talk, I guess you could say, about the potential impact of inflation. And he had his points of what he was going to say.
Yeah.
We always talked about
He was a policy. No, the individual's name, I can't remember. Yeah, but he was a policy expert that worked on the board, the investment committee of this particular mutual fund, and they were fairly successful, a couple billion under management for a new fund. But given specifics about that, and I stumped him. I do remember. Do you remember me stumping him with the question?
But the more, yes. So there are different ways you can look at it, and there's certain different ways that certainly people in policy look at it. But the more interesting thing for me is going to be the seesaw effect that it potentially would have on the market, because that's what we saw last time, where they were going back and forth with negotiations, but you could almost see the market respond to that in real time, because it was like a whipsaw type thing. Yeah. And so that's the question now. Is it going to have the same sort of effect, or do we have the hindsight of 4 years of President Trump and knowing that, he uses these as a negotiation tactic, and it's probably not going to end up like it starts out? So that's my question: is do we see kind of the market itself sort of discount the effect that any potential tariffs might have? Certainly over the longer term, but I think the more risky situation is going to be in the shorter term, obviously, because of things like you said, where you're going to have to find suppliers are going to have to find where to move. They're going to have to set up all that stuff. They're going to have to potentially buy new molds, new things to create, to move this out of China, and then China's response to it as well. I mean, is there a universe in which China could send their goods somewhere else.
Oh, sure.
Via, it's
and
through
try to
China,
get around the
but
tariffs.
a different country, basically. It's marked with a different country. I mean,
Yeah.
people, that happens with meat all the time in the U.S.
Yeah, they'll
they'll
ship the meat out to be slaughtered.
That's right.
A foreign country, and then bring it back in. Yeah,
and they can still say it's a product of the USA.
Yeah, that's ridiculous. But I think the market will have ups and downs. I see that more as a buying opportunity. If you're
That's a good point.
If you're sitting on some of your 401k contribution levels, if you're sitting on your Roth contribution, or if you're just in your brokerage account, you maybe are holding back some cash. Look for those buying opportunities when the market overreacts to something.
I think we just came through one.
Yeah, I mean, that's a great time to deploy capital for the long term. I will say, however, the most uncertainty I think building this year, not to adjust your investment strategy on, but to really kind of pay attention to for expectations, right? Are we going to get 8% S&P? Or are we going to get 20% S&P this year? To kind of adjust expectations is really going to be what happens around government spending. We did speak a lot about that last week as well. So we have the DOGE, the Department of Government Efficiency, coming in. And I would argue that one of the reasons we have the long end of the curve, every aspect of the curve, not really responding to what the Federal Reserve has been doing with rate cuts, and also, mortgage rates, which really kind of looks at the 10-year Treasury,
right,
is because of uncertainty around government spending. The amount, because interest rates have been high now for so long, the amount of interest the government's paying as that debt keeps rolling over at around $5 to $7 trillion every 18 months.
Yep,
it's going to be a big deal. So we got to get spending down to help bring those interest payments down as well, because the bond market, the Treasury market wants to see that. And I'll say real quick,
Yellen saying we're going to have to take extraordinary measures on Tuesday. When the day after the inauguration.
Yeah. I mean, I think but one thing to look at is, and there was another, I didn't send it to you. Maybe after we wrap here, I'll send it and you could insert it. But, with Trump being the first crypto president, the number one market or the number one expectation for the crypto market this year is the Cambrian explosion that's taking place with stablecoins. And when you hear the word stablecoin, think U.S. Treasury, because those are backed by U.S. Treasuries. So when someone opens an app, let's say it's Coinbase or Kraken, my personal favorite, if it's Kraken, and you put cash into Kraken and let's say you want to stick it into USDC or USDT, when you move those dollars from cash to those stable coins, you are purchasing treasuries. And so think about the amount of it's sometimes trillions with a T dollars are in the stablecoin market. That's another buyer for treasuries that could help also push rates down. So it's going to be very interesting to see what happens with the stablecoin market, because if more people, and especially the younger generation, are holding their savings in stablecoins, which are backed by treasuries, you're talking about...
It's not a product of the government, though.
It's not. But
it's not officially endorsed.
If it could be, depending on the regulations and how, if there's stablecoin regulation that gets passed and mandates dollar for dollar backing vis-a-vis U.S. Treasury debt, then you're looking at a substantial amount of buying power. Because instead of people keeping their $1,000 emergency fund or their $10,000 emergency fund paying 1% at Ally as the Fed reduces rates, they can swap it over to a stable coin and get 3%. And all that money is shifting to, now it poses a problem for some of the banks, but all that money is shifting into the treasury market, which would create, again, enormous buying power. And not just in the U.S. Having a stable coin, everybody on planet Earth can own their savings in dollars without having to do KYC, be a U.S. citizen, and go through the banking system.
Yet.
Well, yeah. I mean, yeah, but you're thinking, Nigeria is poised to hit, at the end of this decade, well over 1 billion people with the average age under 30 of the population. And just think about the way they can escape their inflation and their currency that doesn't do very well, and just push a button and stick it into U.S. dollars, buying our treasury debt. It's an enormous market. So keep an eye out on that.
Yeah, maybe more so of a market overseas than it would be here. I don't know. I mean, there are other places you can get yield as well, as the Federal Reserve starts to drop. But
yeah, it's true.
Yeah, I mean, it's going to be interesting for sure. I mean, we can kind of segue into what happened last week. The market performed very well. Best turnaround since November. So we had basically the month of December where it was just choppy. almost the whole way through, particularly at the end. So last week, S&P was up 2.78, NASDAQ up 3.20, Dow up 2.82, and Russell up 3.78%.
That small cap, we're seeing that small cap outperform.
You know, we said that a lot, and it happens a lot. It's like a false start every time. It has to reach that level of support and then keep climbing and not turn it into resistance every time. And that's what we've seen happen. Yeah. So it still has a ways to go, but it is an interesting point to watch. Gold, we got up 1.44, silver up 2.4. 10-year bond actually up 1.4, and Bitcoin up almost 6%, 5.92 last week. So if we look at a 1 year, actually, let's not look at 1 year. Let's look at year to date. So this is the month of January, 20 days so far. Market's not open today. So S&P's up 1.96, NASDAQ is up 2.06, Dow Jones up 2.2, Russell up 2.04, gold up 2.95, silver up 4.86, 10-year bond is flat on the year, and Bitcoin's up almost 12.5%. So there's a lot of, we talked a little bit about the Santa Claus rally at the end of last year.
Which we didn't have. That's right. And so that's sort of it's not an indicator, but it's an anecdote. If Santa Claus fails to call, I think bears could come to Broadwell, I think is what this saying is. But that's not the only thing that people look at to kind of forecast for the year ahead. January is also an important month. A lot of people say, as goes January, so goes the rest of the year. So we'll see how that plays out. But we're looking like we definitely hit some much needed bumps last week, particularly on Wednesday. And then you had on Thursday, actually very interesting, the RSP, it's not the RSP, but RSP is the ticker for an Invesco equal weighted S&P. So the S&P fund, most S&P 500 funds, and the S&P itself is cap weighted. It's weighted by market cap. And so it's basically, we've talked about it before, but it's basically a lot of the Magnificent Seven. And so the equal weighted S&P 500, you can also get that in an ETF. And that is just equal weights across the board for all of the companies in the S&P 500. So last Thursday, you had that overtake the S&P midday, meaning the RSP, the equal weighted index, closed up and the S&P closed down. So this signifies somewhat of a rotation that we're maybe rolling more into big, large cap companies. And it's interesting to see for sure. It was up like 0.8 while the S&P fell 0.2. And that goes back to the conversation we've had about breadth, BREADTH. I'm going to be the breadth man because I keep talking about this, but this is the sign of a healthy market is when a lot of participants are seeing an uptick in their stock price. You don't want to see a very concentrated market because it's not typically a healthy market when you see 7 stocks going up and the rest of everything else is flat or going down. That's almost your recession play.
That's right. And so what you want to see is across the board, every company in the S&P 500 is obviously not going to be up every single day, but you want to see the majority of them up. You want to see the majority of them recapturing their average, their moving averages, their 50-day, their 200-day moving averages. And we saw that last week, which to us would signify that there is definitely some capitulation happening, definitely some support coming on. And it would lead me to believe that we have, at least in the short term, some room to run. And, obviously the markets don't go straight up, asterisk, 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 caveat, caveat, caveat. Risk is associated with it, but these are kind of things that we like to see.
Yeah, I mean, this is when you start seeing if you're working for a publicly traded company, you're getting stock options, you're getting stock grants. Maybe you buy a little bit into your company stock in your 401k. This is the period of time if that trend continues to where you're going to start seeing performance that matches the index or maybe even outperforms the index. That's a great opportunity. Yep. If you've been at a loss over the last few years on your company stock grants or your stock options and you start to get in the money on them, it's a great opportunity to reach out to us to look at some diversification, some other options to kind of take your profit and have it kind of locked in 5 to 7 years where you're not really worrying about individual stock performance. It all depends on your risk tolerance and where you're at in your retirement planning. But yeah, market breadth is a great thing to do. You have to say that or it comes across like breath. It's a great thing.
You have to spell it.
And we also saw the energy sector benefit from a rally in oil prices. If we look at inflation, we look at oil prices, I think we're going to be coming up to some pretty good comps, because you have to remember when you're looking at monthly CPI data, it's always measured against what was going on at a previous period of time. So if you have good comps on that, you get some pretty good readings on the data. I'm still bearish on, I guess bearish. I'm still, I don't think we're going to see, we are going to see nat gas and oil prices adjusted for inflation be relatively low, but I'm not so sure we're going to see utility prices come down in the near term. So even if we're flat from an inflationary perspective on utility prices, they're still really high for a lot of people. We talked about that last week as well. We're looking at a lot of energy issues. There's not 1 gigawatt of available excess energy in the entire country. A lot of demand for AI compute. There's a lot of demand for manufacturing expansion, things that are going on here. That demand is only going to grow, and it's probably going to grow on the margin exponentially, how much more we need.
Well, that's why we were talking about Greenland last week, and that's why Trump is talking about Greenland. And we talked about it last week, but Trump is not the first president or the first sitting elected official to talk about the United States' interest in Greenland. But the kind of overview, 30,000-foot view is it's a natural resources play. Greenland has uranium, which is necessary for the nuclear energy,
especially the modular nuclear reactors. Right. That's been getting some traction
with tech companies that need the power to power the supercomputers, the quantum computing, the AI play. And then the climate is also very cool. You don't have energy costs to cool down buildings and cool down data centers that run very hot. We talked a little bit about Louisiana with their deal with Meta for this big data center.
It's like a 9 million square foot. It was
it's like 14 million or something.
It's huge. It's gigantic. They made a deal with Entergy.
That's right.
Which is
having to partner with an energy company. That's right.
To pipeline in that nat gas for their power generation.
Yeah, so it's going to be a big deal. I mean, if they can make it work out, it seems like the people of Greenland are at least open to the idea, at least according to the news that I've looked at. It's not very many people live. I think it's under 60,000 population. And so it's an interesting play for sure. I think the immediate reaction from most of the talking heads and news stations is sort of like it's a joke. I mean, that's what they want to make it essentially. But there is some real...
The U.S. government has been eyeing that for a very long time.
Yeah, I mean, there's some real reasons why you would do it. It's not just... you talked a little bit about the shipping routes as well.
The shipping routes.
Surely important. It's
the ice, the season for the shipping routes to be blocked because of the Arctic ice is getting shorter and shorter every year, and it has over the past 50 years. So you have a situation where the climate is changing there, and it's opening up shipping routes that are extremely important. We talked about how, England at the time, which is what the size of Alabama, not the entire island, but England itself, conquered the known world essentially because it controlled the shipping routes with its naval power. So, those shipping routes are extremely important. The minerals are extremely important. So let's just see, withhold judgment until you kind of see what's going on. We have to have rare earth minerals if we're going to compete with the Chinese and the Europeans on the next generation technology that's coming about, not just artificial intelligence, but also defense technologies. If you look at some of the things, this company called Anduril, they're a private company now. I'm sure they will become public at some point, but the technology they're developing that's already in use essentially could replace the need for the F-35. And it's incredible, but we need these rare earth minerals in order to achieve a lot of this. So you got to think, do we want to buy it or be held hostage by the Chinese to get it? Or could we find a better solution for it? And I know a lot of our clients in South Arkansas have drawn our attention to the lithium deposit in that, what's it called? It's an underground aquifer that has high concentrations of lithium in the Smackover Formation. Very, very important, but we need more. So, yeah, I mean, it's things to watch, a lot of exciting things, and excitement could be both nervous anticipation. It could be, welcoming changes that could be coming, but there's going to be a lot of excitement this year, one way or the other. And don't let it sway you from your long-term plan. Work with a professional to help first get your expectations in line with reality, and then execute a plan that keeps your money growing and lasting you into your retirement and into your old age so that you can enjoy life and enjoy a work-free life, as we like to call it. So let's look at things that are coming up. You mentioned Tuesday with the outgoing Treasury Secretary Janet Yellen stating debt ceiling issues. So I'm assuming the Congress will get together to solve that. Trump has been, I believe as of late, has been really against the debt ceiling being used in its current form. So it wouldn't surprise me for that to get lifted. Again, what matters the most is future spending relative to GDP. That is what matters the most. So you're not going to do anything with the debt ceiling anyway if you can't reduce spending relative to GDP and then also grow the economy faster than it has grown. The debt ceiling is not, to me, it's not really important. You don't need to think about it like, the media will have you think about the debt ceiling kind of like a credit card limit. Well, if you're maxed out on your credit card, you need to reduce your expenditures. That is true. But the economy, it's looked at more like if your economy is growing consistently, if your income is growing every year, then the moment that credit card hits that limit, it's not that big of a deal to you if your income has gone from $200K last year to $250K this year. Right? You can manage it and you have options.
But you also still want to control the spending.
Yes,
you do. Also the part of the equation. But the other thing that Trump particularly is going to come against is that the Biden administration kicked the can down the road on a lot of this stuff. And they did it until right after, they knew they wouldn't be in office. So the other thing you're going to be looking at is there was big news a couple months ago when the port workers were going to strike because of automation.
Yes.
And they came to a deal that basically would get them into January and maybe February. So he's going to come up with that. That's going to come up here soon, and he's going to have to make a decision about what. I've
forgotten all about that. Yeah, they'll have to negotiate
so you'll
that.
Have, more supply issues potentially there coming in and making kind of a mess of things. But, the inauguration is today. That debt ceiling conversation is going to be happening on Tuesday. We also have unemployment claims coming on Thursday. And the Federal Reserve's Beige Book is due out on Wednesday, which is going to give us insights into regional economic activity. And so the other thing we're starting is earnings season is starting like next week. So there's just going to be one after the other, earnings. And, we have some decent expectations for earnings based on spending of the last quarter of the last year. So we'll see if that plays out. But if we do start seeing earnings be positive, people beating earnings, companies beating earnings, then that's going to be very bullish for the market. So we could be at a position where we just had a really good buying opportunity. There will be certainly buying opportunities in the future, but we always want to keep watch over that. And one of the ways we do that is with our indicators. None of our short-term indicators flipped during this whole little
market pullback
blip we had in December and January. So for us, that is
we're not seeing weakness.
That's right. That's confirmation that we're maybe in a buying opportunity. We did do some buying at the beginning of January. So
let's so I guess to wrap up on last week, the takeaways. The rally really demonstrated that we're in a resilient position. The consumer is still spending. We have the breadth, also known as the broad-based participation.
Maybe that's a better way to say it.
Yeah,
broad-based participation.
We're looking at the bond yields, inflation trends, still something to pay attention to. And then this week again, headlines. Stay informed. We want you to stay informed, but take it with a grain of salt. We have debt ceiling negotiations. How is that going to affect the market in the short term? And then again, the earnings, like you just stated. Earnings are going to be important. I'm pretty bullish on earnings. We'll have to see, but I'm thinking a lot of our big companies, especially in the tech spaces, are going to probably surprise.
Knock on wood.
Knock on wood. And so, anything else you'd like to add? Are we missing?
No, I mean, it would just underpin the kind of point. Sometimes we talk about current events or things that we get a lot of questions about from clients. And so one of the things that we're going to but one of the things we sent out our annual review emails last week. And so a lot of people have scheduled their annual reviews. We're going to be talking about kind of market performance and how the accounts did and, what we're looking for in the future. But this sort of underpins, when we're looking at a market like this, it underpins the point of diversification. And so for us, diversification is going to be diversification of assets. That's why we do things like allocate to crypto, allocate to small cap, change allocations to large cap. We're going mid cap. We change out sectors once every 30 days. Sometimes we hold sectors, sometimes we sell them. We may be in consumer discretionary, we may be in technology. All of these things are all in an effort to diversify the portfolios, but also leave opportunity for growth. And so there's a kind of a confusing thing. And a lot of times when we get a new client, they'll ask about this, which is that diversification for some people may mean, I need 2 or 3 advisors, and that's diversification because I don't want all my eggs in one basket. That sort of anecdote gets sort of lost in translation because that's not exactly what it means. Diversification is just you want to be in broad assets across the board. And so
you want to have a strategy that allows you to, in a very nimble way, which is what we do here at Momentum Wealth, to take advantage of the momentum in any given asset class, because they're not all created equal and they don't all perform the same. So we want to be very open-minded, pay attention to the data, and understand, okay, can we allocate to gold? Can we allocate to crypto in a strategic way to take advantage of the market momentum so that our clients can make more than they otherwise would have made? And we've seen that specifically in tech, gold, and crypto over the last 12 months.
Yes.
Just having a small allocation can mean to something that really outperforms, can mean the difference in just matching the S&P or getting an extra 6, 7, or 8 points on top of that, which really helps you in retirement. It helps you with the cost of living. And it also helps you not have to feel you need to be so aggressive necessarily, because we do this across all of our portfolios, whether they're conservative, moderate, or aggressive investors. So if you have a moderate portfolio that allows you to really outperform, it really settles you down and keeps you from wanting to reach further and further out on the risk curve because you feel like you haven't done enough and you haven't made enough for where you're at in life. So yeah, it's market momentum, and how we take advantage of it is using our knowledge, being prepared to understand what's going on with the data, staying informed, and being very strategic in
very technical data.
Yeah, and how we do that.
So when we're talking about earnings, that would be something more fundamental.
Mm-hmm.
Basically, two parts, 2 ways to look at it: technical analysis, fundamental analysis. So your fundamentals are going to look at your earnings appreciation and your price to book and all that kind of stuff. And technical is just looking at the price movement and the movement of charting and things like that. And so we look at it from a very technical standpoint. But the interesting thing about earnings is that you have the potential there for outsized returns based on what they report. Yeah, based on the earnings. Yeah, based on how profitable they were.
What are the shorts? What are the longs doing?
Right.
What's the option chain look like? And then you can measure that against, okay, well, if we get outperformance on earnings, then based on the chart, which would be the technical side of things, we would expect the price to do X, Y, and Z.
Right.
It doesn't always work, of course, as you know, but we view from our fundamental, when we look at the market from a fundamental perspective, we're not really looking at it in that traditional way, like you're talking about your PE ratio, your price to book, your profitability, the dividends. We're looking, when we use the term fundamental, it's more or less understanding we want to be in broad-based indexes and we want to have a good allocation to various asset classes. That's our fundamental approach. And then how we actually execute that is driven by technical analysis and indicators derived from price movements.
Right.
Using it,
so that's how we're able to. That's the risk side of it.
That's your risk side.
Yeah,
that's your risk side. So, and I've learned, and as most of those watching would have learned, a lot of you can have a 30 or 40 year period in the market to where a company making a certain profit deserves a certain price. And then really overnight, as technology improves, that entire paradigm of how you have viewed the market can crumble. We think about Facebook, Netflix. You think about Amazon didn't show a profit for like 20 years because they were reinvesting and they understood the growth trajectory. If they are constantly reinvesting and they're borrowing out in the bond market, they're taking on more investor cash in order to grow their business, they're going to sacrifice short-term profitability for long-term gain. And the market has really shifted to a point to where we're at the convergence of so many, exponential growth areas, from technology, from artificial intelligence, full self-driving, nuclear energy, solar energy, space travel, all of these things, CRISPR therapeutics, being able to take vaccines to specific cancers that you have, a tumor that's specific to you with your genetic material, be able to take that, analyze it, produce a singular vaccine for that cancer tumor to get rid of it. I mean, it's remarkable the technological advancements that are occurring. And so you're going to have a lot of companies that when you look at it from a fundamental perspective, like Tesla, you're going to say, oh my God, the price to earnings is like way out in left field compared to GM and Ford. Yeah. Well, it's because it's not a car company, really, when you get down to it. So the market's already priced it at this level. Why? Well, because it's not a car company. Yeah. So you can't really, I tend to stay away and discourage people from really looking at profitability and the past with companies. And if you're going to be a single stock investor, or at least to have a portion of your portfolio in single stocks, you really have to do the research and the data, understand where these companies lie in these massive S-curve adoptions that are taking place with technology. And then you can kind of look at your Teslas, you can look at your Apples, you can look at
I mean, if you're trading in like large cap blue chip companies like that have been around for a while and established, I think fundamental analysis is probably a pretty good place to start.
Yeah, Coca-Cola, Walmart.
Yeah, I mean that's your Warren Buffett basically, and so I think it works.
Well, people have to keep in mind that he bought an insurance company, so he used the float to.
Well, that's true. He's got. I mean, yeah, you're right. Anyway, we're up on 41 minutes. So I think that that is probably a good place to wrap it up. We look forward to the week to come. We're excited about that. Excited to see what happens in the markets. If you have not yet scheduled your annual review, please do so. We sent out the calendar. If there's any kind of conflict or you can't find a time that works for you, please reach out to us. We or maybe Sarah, one of us will find a time that works for you. So have no fear for that. But,
yeah, and we've done some traveling around to the various kind of centers of where our clients are this year. But it's with the winter storms, everything taking place, it looks like there's about to be a whole nother round of them in the next few days. Don't be afraid to click on our video link to schedule a Zoom for your annual review. There's no need to get out and icy roads or snow, because I think I could take my Tesla on icy roads. It has a setting, but
go for it.
I don't. If I wreck, who's going to get me? Who's going to get me out? So, keep in mind we have several different options depending on the time of year, what our travel schedule looks like, to whether it be in person, by the phone, or video call. With our annual reviews, the most important thing is just to connect with us and have a conversation. So if it's just telephone, if it's just a Zoom video, we want to speak with you, kind of see what's going on. And one other thing I will say that I meant to send you a text message on over the weekend, and I got to doing other things, but keep in mind, this is really for all of our clients out there, to always keep us informed if you're going to be traveling abroad out of the country, or if you're going to be going to maybe a high risk, high security event. I know we had clients going to the inauguration. I know that's been changed because of the whatever. Yeah, I mean, that's all being security, weather, whatever is all being changed to indoors. If you're going to be going to a high risk or high security event, and we got to think about, our Louisianians that were down in New Orleans around that event. If you're going to be going to a high risk event, always shoot us an email and let us know. If you're going abroad, if you're going to, again, a high risk security event, I'm trying to think about, any of your big cities, maybe a big concert in a big city that's kind of out of your area that you're familiar with. Keep us informed. Just shoot us an email and say, hey, by the way, I'm going to be out of the country this date. There's several reasons. I won't get into it now, but there's several reasons why it's good to keep us informed on that, to help protect you and your account from any fraud. And also, God forbid, if something were to happen, we're able to seamlessly help your family adjust in the event of a calamity. So keep us informed, keep us updated. And I guess we'll still have to send an email out on that, because everyone would have had to made it to the 45-minute mark to hear it. So
It's true. I'll add timestamps here. So anyway, we will, thanks for staying with us if you're stayed here this long, but we'll see you back here next Monday for another Moment of Mondays. We'll
Take care.
Bye-bye.